The data is in. If you bought an Airbnb in cities like Phoenix or Nashville over the past 2 years, you're fucked. Revenues are down by almost 50%. Now, before I break this thing down, I need you guys to help me out. I'll even give you a second to do it. I'll pause. I need you to like, subscribe. While you're doing that, you can see a picture of my newest amenity, sandboards in a shed by my Airbnb. So let's throw it up. Boom. Thank you so much. I appreciate it. So why are we fucked, you ask? And I'll say that May's data, May's revenue per average Airbnb in these markets is down almost 50% on a year-over-year basis. Where if you earned $6,000 a month in Sevierville, Tennessee in May 2022, you only earned $3,000 a month in 2023. Now, that is a huge problem for hosts that joined over the last 2 years. And they're likely losing money now on a lot of these loan products. Luckily, their misfortune could actually turn into opportunity for you. Since a lot of these sellers have mortgages that are anywhere from 3 to 4.5%, you have a chance to acquire their existing mortgage and maybe even have them seller finance some of the rest of the equity. So as home prices start to slide, as these investors start to sell, these are buying opportunities for many investors out there to finally get Airbnbs below the crazy prices we've seen over the last 2 years. Now, a lot of people are confused over what seller financing would look like if they wanted to buy an Airbnb off of a seller and acquire their existing mortgage. How does that work and what does that look like? And I'll give you an example. I'm actually selling my Airbnb right now, my one in Denver, which is down 22% over last year. I'm selling it with seller financing to access the equity that the house has built up for me over the past 2 years. And if someone were to buy this off me conventionally, they would need to put up to 20% down on a $700,000 house. This is over $120,000. And they would need to have a 7% rate, which is a $4,000 a month cost. Now, if I seller finance them, they need to take over my mortgage, which is $465,000 or about $2,300 a month. And then I will seller finance them some of my equity. I'll give them a personal loan of $100,000 and expect it back in 5 years, but amortize it over 30 years. Their monthly payment would only be $2,900 if I sell to them in this way versus $4,000 if they buy it conventionally. So you can see there is a huge difference in your ability to cash flow on Airbnb if you finance it off of the seller and acquire their cheap mortgage, or if you come at today's mortgage rates. So it's not a bloodbath everywhere. While if you in Phoenix, if you're in Nashville, you might be in a tough spot, there's plenty of markets out there, the undiscovered gems of the world, that are doing just fine. And these typically in today's world, cities are doing okay right now, and some remote areas that weren't overbought, that didn't get oversaturated are doing fine. And those are generally off the beaten path. They're a few hours from a city, they're drivable, they're not fly-to markets, and that's why they're still able to do well even in a tough economic time. And they're also in an area where there weren't thousands of Airbnbs flooding into them. They never showed up on any of the top 20 lists. Markets like I'm in, markets like South Central Colorado, please don't go buy up the whole market after me. But there are some bright spots out there in my current portfolio that you could take as some learnings on how you can invest in this market. But the formula that I see for success is go with more unique properties. Go with more experiential properties for people. Don't just provide a cookie cutter basic property. In 2023, that's going to lose. More than ever, competition is important. Build that custom furniture, put the 5 holes of mini golf outside like Rothbill is doing. Go extra so you, for some reason, stand out above your competition and you future-proof your house where if it gets saturated, you continue to be one of the top picks for people. But I continue to see ways to invest in 2023. So I'll give you some tips over what I would do, what I think you should do if you want to follow this data to invest this year. And number 1 is you need to start with a location you have some expertise in. We're not going to drop a pin in Utah and go invest there. If you live in Chicago, like me, draw a radius around Chicago and find places that you vacation as a kid or you know friends and family that go there. And then step 2, go to a data site like Airbnb or alltherooms.com and buy a 1-month subscription to that market. Once you have that, you have historical data you can analyze. The most important for me is the ratio of demand to supply, the number of listings relative to the amount of listing nights booked per month. Using that, you can create a ratio. You can look at how that trends and you can filter it down to the size listing you want to acquire. Once you're confident it's not oversaturated, like Phoenix and Nashville and Sevierville, then you have to figure out how to enter this market. Find things on Zillow, underwrite them, find the revenue on data.rabu, and put together an underwriting sheet for how much money it would make. And if it makes more than 10% return and you're confident with its competitors, buy it. And then beat the other competitors you've identified by leveling up past where they're at. Put better amenities, better furnishings, better photo, and you will win. Make more than them, and then scale. Now, if you're looking to acquire a short-term rental in 2023, but you're scared of saturation and the Airbnb bust, I can help you. I'll drop my Calendly link in the description of the video, but you can book an initial consultation with me, and we can help work through your goals and your strategy. And what I described, buying in a remote market that isn't oversaturated, I can help you do. So like, subscribe, follow along. I'll show you how I implement these strategies myself.